Welcome to the Boomers, Bucks, and Bling podcast, where we turn retirement planning into a bit of a thrill ride. I'm your host, Carl Spiteri, and each week we'll dive into everything from reverse mortgages and staying put in style to Medicare, Social Security, and home safety. But wait, there's more. We're not just going to talk all about money and business. We're going to add some sparkle, some bling, as we chat with travel pros, party planners, and a lot of different topics that's going to help you make the most of your golden years. So grab a cup of tea or whatever it is you want to drink, get comfy, and let's make retirement planning an adventure of a lifetime. Welcome to this edition of Boomers, Bucks, and Bling. Today we have the privilege of bringing back John Breyer from Blankenship and Foster. And today we're going to talk about a kind of a different subject. We're going to talk about tax surprises in retirement and maybe some distribution thoughts on how to get your money that you've worked so hard for. John, welcome back to the show.
Well, Carl, thank you for having me on again. I appreciate it.
Our pleasure, our pleasure. So, um, I think our audience knows who you are. So, just give us a few seconds here of your intro. Give us your information in case somebody didn't catch the last episode.
Sure, absolutely. Well, my name's John Breyer. I'm a financial advisor. I work with families mostly in the Southern California area in San Diego, North County. My company is Blankenship and Foster, and we're in Solana Beach. And so a lot of the people we work with are in that area too, but we work with people all over as well.
Okay, great. Well, today we're going to talk about tax surprises in retirement. So, what's the number one tax surprise that you think people face in retirement?
Well, Carl, I'm remembering the last time we talked that we talked about a big surprise to do with people's real estate, the house they live in. If they're looking to turn that real estate equity into retirement income, they often have a big surprise on disappointment of that it doesn't do all the things that they want from it. So that was a big surprise that we covered in the last episode that I talked to you with. But another really big surprise comes from how they've saved their money over the years. A lot of people that have worked for many years have put money in their 401k or their IRA, and they got a tax break for doing that. So it helped them save, and they got a tax breaks for putting money in there. The big surprise comes from when they go to take it out. It's all taxable income. And so when you have a 401k that you're depending on for retirement income, and every dollar that you're taking out is taxable, there's a tax on it. And the real double whammy, what I would call it, is that you have to pay the tax. And so where are you going to get the money for the tax? If you're taking the tax out of the 401k also, that's the double whammy. If you don't have another source of money to pay the tax on those distributions, it gets really expensive really fast. As you know, we have a progressive tax system that the more income you have, the higher the tax is on it. So we see where people get boosted into a higher tax bracket just because they have to take more distributions from their 401k or IRA to pay the tax on what they needed in the first place. And
So,
so,
as an example, you need $10,000.
mhm,
So, and you have this 401k that's or IRA that's sitting there, right?
mhm,
And you take $10,000 out of it. On that, say you're on Social Security income, right? So you're getting your whatever you are on Social Security, your 3,000 a month,
mhm,
and you have a part-time job or something, so you're bringing it a little bit more. So now
mhm.
you're on the $10,000 that you need, you're paying state and federal taxes on that in whatever category you fall into, 15 to 25% probably in that
Mhm.
scenario.
Yeah.
So the $10,000 will net you eight, seven, right?
Yeah. Well, that's
Or
right.
you have to
Yeah,
take out
let's
13, right?
Yeah, that's the thing. Yeah, if you're taking $10,000 out of your 401k and your tax on it is going to be 2,000 or $2,500 because you have to pay federal and state tax on it, where are you going to get the money to pay that 2,000 or $2,500 tax? If you need to take it from the 401k also, and a lot of people do that. They just do tax withholding from the distribution.
Mm-hmm.
And on the tax withholding form or doing it online, you check, do you want it to be a gross amount that you receive, or a net amount. So if you need $10,000 and you put net of tax withholding I need $10,000 to come to me. Um, then that $2,500 check that gets sent to the IRS and to California, it needs to be more than $2,500 because you had to distribute 12,500, not just 10,000. And that 12,500 is all
Huh.
taxable. So you just raised your taxable distribution. You just raised your taxes from the way that you're paying the taxes in the first place.
Yeah, that's a really good point. So that is a big tax surprise. That is a very big
Big
tax
tax
surprise.
surprise. Yeah. And we see that a lot of people have taken advantage of money they can put into those vehicles where they got a tax break on it. And if they end up in retirement with that's really their only savings and investment,
Hmm.
then they're definitely in that loop of paying more and more tax on it. And it gets steeper and steeper. And you can see where that really starts to deplete their money over time and
Hmm.
cause them all of a sudden to starting retirement with a whole lot of money that you've built, and there's a big number there. But when a lot of
Hmm.
it's getting eaten up for taxes, it starts to decrease fast, and that's a big surprise.
When you do planning for retirement, and how long do you plan for in today's world? Because when Social Security was started, what the average person lived like 3 or 4 years after retirement age, or
Mhm.
some crazy thing like that, right? I mean,
Mhm.
it's a lot more than that today. If I came to you and said, "Okay, I'm going to get ready to retire. How long do I need to plan for?" What would you tell me?
Well, at least
Because
20.
this could be a surprise, right? Okay,
It
go
could be a
ahead.
surprise. Yeah, longevity is a surprise too. People that live many years into retirement, they didn't count on living that many years. But certainly 20, 25 years, if you're starting at age 65 in retirement, just as a rule of thumb, you should count on living well into your 80s or even 90s. Or if not you, if you're married, your spouse will. So one of you,
Hmm.
survivor, can count on living into their 90s. Very common. And so that's a lot of years that you need to have your money last. And so if longevity is a big surprise for people, also the other big thing is inflation. That the money that you've
Hmm.
saved may look like a big number now, but in 25 years, that $1 million is the equivalent of maybe $300,000 in those future years, what it will cost to live on.
So a way to think about it is, those of you that are listening, is if you bought your home 25 years ago, or if you owned a home, what was it worth 25 years ago, and what is it worth today? It works
Hmm.
the same thing with money, right? It's just in the opposite direction. So that's
It
something, that's the
does.
good think about it.
Yes. Yeah. So I always encourage people to think about longevity. What if you live a long time and then, just inflation, just kind of the average inflation that we've seen over the past 30 years. If you just continue that over the next 30 years, that's without,
Yeah.
even big spikes like we had in 2021, 2022, 7, 8,
Hmm.
9% inflation. That's a destructive force on your money.
Yeah. Yeah. So what other surprises?
Well, the biggest surprise that we see is health related. Your health changed on you, and what you counted on doing, you can't do much of or any of it at all. Your day changes from having fun and living life to going to doctor's appointments and treatments and things like that. So that's a big surprise for people. Now, financially, that big surprise can work out fine if you have really good insurance coverage. But for other people that don't have really good insurance coverage, it can really drain their finances fast.
Yeah.
Medical is kind of the number one reason for financial distress in households today in America. So that's a big thing. The
The word
support.
of the wise: get a good insurance broker. Make sure you have real good insurance,
Yes.
right?
Mhm. Yeah.
Even if you feel you can't afford it, it's probably try to afford it, right? Make
Well,
sure
yeah.
you can.
And sometimes it costs a little bit more to have better insurance, but it also
Hmm.
makes life better when you need medical care.
Exactly.
So, a lot of people scrimp on their insurance and go with the cheapest thing out there. And you can, as a senior over age 65, you can pay pretty much nothing for your health insurance. But
Right.
when you need care and you need help, it tends to make life really difficult trying to pursue navigate the system and fight your way the gatekeepers and make your way to the people that you really need to get in front of for help.
Yeah. Okay. All right. What else?
Well, there's a surprise that people get that's related to that too. Medicare has a premium on it that's not too bad, but they added to its surcharges based on your income. And so, like we talked about, if your income gets higher than you thought, because maybe you're having to distribute from your 401k and that makes your taxable income higher, you're also going to have to pay more on your Medicare premiums because of those surcharges. That can get really expensive. So that's a big surprise that we see that people are having to pay more for their healthcare insurance than they thought because of those surcharges. And so that's a big thing. The other thing that's related to it is Social Security. Social Security is something that people paid into for all their working years and they
Yeah.
expect to get it out. Well, sometimes it can be taxed heavily based on your income in retirement. So if your income's really low in retirement, and you're getting a Social Security benefit, you might not have to pay any tax on it. You might not have to claim it as income at all. But once your income rises to the next phase there, well, it becomes half of it becomes taxable if you reach a certain threshold. And then you get to the next threshold, 85% of it is taxable. And so
Wow.
that's a surprise. People didn't expect to have to pay all that tax on their Social Security.
Yeah. I mean, my goodness, that's if your income's that high, that means you're in the higher tax brackets as well.
Hmm.
So yeah, you're almost not able to keep any of your Social Security at that point.
Yeah, it's a loop sometimes.
Hmm. Okay. Well, anything else? Because I was going to flip over to distribution challenges and things, but any other common surprises?
Well, those are the big ones I see,
Okay.
related to their healthcare, related to their savings and how they're pulling money out and paying taxes, and their real estate,
Okay.
these things.
All right. So flipping over to distribution then. So say I own a home, I have a retirement account, I have a savings account, and a small pension, and Social Security, of course.
Hmm.
What order do I take money from? What should I access?
Yeah, great question. Well, and if you're lucky enough to have a pension, that's a real blessing right there. And so
Hmm.
if the pension is solid and you can count on that throughout your retirement, that's a real plus and puts you in relatively rare company. But the pensions are just less and less common every year.
Yeah.
So, a big thing with that pension is also, is it going to increase? Does it get cost of living increases? Because if it does not, a lot of pensions do not increase. And so that the income that you're getting in future years is not going to be worth as much. And so you really need to make sure you're keeping enough in savings to compensate from that over time. So really, that's to say, if your pension's not going to be increasing, um, be careful that you're saving enough in money to compensate for that later. Also, pensions can have survivorship options. So if you're
Yeah.
the pension holder and you have a spouse that's depending on that income too, and you pass away, what's your spouse going to get? Will she get zero? Will she get 50%? Will she get 100%?
Yeah.
And a lot of people had that choice when they took out the pension, how much survivorship option. And if they chose zero survivorship, they got the highest possible income, but nothing to the spouse when they pass away. So they pass away early and the spouse survives them for many years. There's nothing there. The spouse will get Social Security, and not two Social Securities, but just one. And then it's savings and investments that your spouse is going to have to live on.
Yeah. So with Social Security, it's important to know that if you're both getting Social Security benefit and one spouse passes away, you basically get to make a choice whether you keep the one you have or you take the other one if it's higher, but you don't get to keep both.
That's
So
right. You don't get to keep both.
yeah.
Hmm?
So there's going to be usually some income gone once one spouse passes.
Yes. Yeah, that's
Okay.
right.
So take your pension as soon as you can. Take Social Security when it's appropriate, whether it's early at retirement age or after retirement age. You determine which way you want to take your Social Security benefit. And
Well, yes, because you get some really generous benefits for waiting to take Social Security. You get delayed retirement credits, and those are really generous, and they apply to your spouse if you pass away too. So it increases the survivor benefit as well. And so for people that can delay Social Security for a couple of years, maybe from age 66 to age 68 or so, they're going to get about an 8% increase on their benefit, which
per
if you live
year,
a
right?
long life per year, yeah. And so that, or actually it's 8% per year. So if they delay it 2 years, they're getting 16%. So it's
Yeah.
the maximum credit you can get gets up to about 25% increase on their benefit over if they just started regular full retirement age. And that makes a huge difference later in life when, maybe your savings has dwindled a little bit, you've spent it down,
Hmm.
and there's not as much security later in life that can provide it. Because Social Security income, at least we're holding on to that premise that gets cost of living increases too, and it lasts for
Right,
the rest of your life and your
right.
spouse's life. Really hard to get that from any pension or to count on any savings or investments to do that, to keep paying an
Yeah.
increasing amount for as long as you may live and your spouse lives. That's a really tall order, and Social Security promises that.
Okay. All right. So we got our pension. Now we got our Social Security. So now I got savings account and I got retirement accounts. Is there a preference on which I take money from first?
Well, we'll look at that retirement account if it's a what's called a pre-tax retirement account, where you got a tax break for putting the money in and you've never paid taxes on that money. You're going to
Hmm.
pay taxes on it when you pull it out. And so when you reach age 73, then you're required distributions. You have to start pulling money out and paying taxes on it
Hmm.
then. So there's often a window for people that are in their 60s and they're hitting that retirement switch and their income's going to be really low. We'll encourage them to take a little bit more out of those retirement accounts and pay tax on it, which may, be counterintuitive. Really, why would I want to pay more taxes than I have to? Well, it's because maybe you're going to be paying taxes at a lower rate now than you will in the future. And so you're paying taxes in a lower tax bracket now, and saves you from having to pay them taxes in a higher tax bracket later. So,
Okay.
so we call that bracket filling, right? Fill those lower tax brackets with income while you can, because if you're going to be in a high tax bracket later, then you're going to be paying more taxes on it then.
Hmm. Good point. And of
Mhm.
course, everybody knows I'm an advocate for reverse mortgages, and a reverse mortgage is the way to get deferred income, tax deferred income as well, which we didn't cover as part of financial advising, but as mortgage, you can get money out of your home without selling it, and the money is tax deferred. We never say tax free because there's always a tax you pay, but you don't pay it at the time you take it out because it's essentially a cash out refinance.
Sooner or later.
Sooner
Well,
or later, yeah, you're
yeah.
always paying taxes.
hmm Yeah, it's inevitable, huh? But yes, that source of income can help you leave more of your retirement savings intact and not distribute them and pay tax on them during your life, which for a lot of families makes all the difference. They can pass on money that tax hasn't been paid on it, especially just like a regular brokerage account that's you've had stocks and bonds in there and they've grown over time, and the tax to distribute it out may be huge, but if you don't have to distribute it out, when you pass away and pass that on to your heirs in the next generation or even your spouse, the cost basis of it steps up, and all that tax that would have to be paid on it just goes away. So it's a unique thing that if you can preserve some of your money and not have to pay taxes on it at all, then it really is tax free.
The key to that, everything John just said, for those of you listening, is step up. The
Step up,
step up
yes.
tax basis. That is
Mhm.
the key to what he just said. So if you don't
Yeah.
understand it, give him a call, talk to somebody who knows. But the step up tax basis is very, very important to
Mhm.
retirement planning. So
Oh yeah. Mhm.
John, again, I don't want to keep you. I promised you a short period here, but I just want to thank you for all this information. Let our audience know how to get a hold of you in case they'd like to.
Absolutely, yes. Well, you can find me on our company's website, Blankenship and Foster. Our website is www.bf, like Blankenship Foster, advisors.com. And if you go on there, you can pull up my page and you can email me directly, just right on that page. Or you can go on
Okay.
my LinkedIn and message me from there.
Okay. And then there's this other thing that we use to communicate sometimes with. It's called a phone. Do you have a
That's
phone
right. We
number?
do. Yes. We have a phone and we answer it. And so here's our phone number. It's 858-755-5166. Call us
John,
anytime.
thank you so much for your time. We truly appreciate it, and we'll be talking soon. Thanks for tuning in to this episode of Boomers, Bucks, and Bling. We hope we've managed to mix a little enlightenment along with fun. If you enjoyed our conversation, don't forget to hit the subscribe button so you'll never miss out. And if you got a moment, drop us a review. It helps spread the word and keeps us motivated to continue. Got burning questions? Hot topics you want us to dive into? Let us know on our website or social media. Until next time, Carl Spateri here to remind you to tackle retirement with a big smile and a whole lot of energy.
The content of this podcast is intended for informational purposes only. It does not constitute financial, legal, or professional advice. You should not rely solely on the information presented here to make any decisions. We recommend seeking the guidance of a qualified professional for any specific situation. Arc Latex Financial Services, LLC, NMLS number 2143, its hosts and guests cannot be held liable for any losses, damages, or other negative consequences arising from your use of the information presented in this podcast. For license information, visit www.nmlsconsumeraccess.org. Equal housing opportunity.